Hello, this is the 42nd episode of What Would Peter Lynch Do?, which explores the wisdom of legendary investor Peter Lynch. A listener asked, can you introduce the basics of the stock market, such as the types of the U.S. stock market, trading methods, trading hours, and after-hours trading, and explains the relevant content.
That is a fantastic question. Really fundamental for anyone just starting out with investing. It definitely can feel like a lot of jargon at first.
Oh, absolutely. Easy to get lost.
Yeah. So our mission today is kind of cut through that. We want to unpack the basics of the U.S. stock market, where stocks are traded, how you actually do the trading.
The nuts and bolts.
Exactly. But we also want to go a bit deeper, right? Get into the philosophy behind it all. Like, why are some companies listed even if they aren't making money yet? Seems weird.
Right. That's a big one.
And this whole idea of the market being just a casino, I think that misses something important.
It really does. There's a whole engine behind it. Hopefully by the end, you'll see it less as just numbers flickering on a screen and more as this engine for innovation.
Okay, let's unpack this.
Okay.
So, to kick things off, let's paint a picture of the U.S. stock market landscape. Maybe think of the different markets like different kinds of shopping centers.
That's a pretty good analogy, actually. Helps visualize it. When you're talking U.S. stocks, yeah, three main places usually come up. First, you've got the big one, the New York Stock Exchange, the NYSE.
The classic, right?
Totally. Oldest, biggest in the world. It's home to those, globally known, financially solid, large companies. Think of it like a luxury department store.
Like Harrods or something.
Yeah, exactly. Full of famous, established brands. Coca-Cola, Johnson & Johnson, Disney, those kinds of names. Historically, it was all option style on the floor, lots of shouting.
See the movies?
Right. Now it's mostly electronic, but the key thing is it has really strict listing requirements. Very prestigious. Then, completely different vibe, you've got Nasdaq.
The tech place, pretty much. It was the world's first fully electronic market. Definitely the hub for technology, biotech, internet stuff. If NYSE is the grand old store, Nasdaq is like a huge cutting-edge tech mall.
Okay, so Apple, Microsoft.
Exactly. Amazon, Google, Tesla. They're all Nasdaq giants. Everything happens via computer networks. Its listing rules are still tough, but they're structured differently. Often a bit more accessible for innovative startups, maybe focusing more on growth than instant profit.
Ah, okay. More flexibility there.
Yeah, which means you can find companies with huge growth potential, but maybe also more volatility in their stock prices. Swings can be bigger. And the third main area is the over-the-counter market, or OTC.
Okay, what's that about?
This is where stocks trade if they're not listed on the big exchanges like NYSE or Nasdaq. It's kind of like an online bulletin board, or maybe peer-to-peer trading.
So smaller companies.
Often, yeah. Smaller companies, maybe startups or companies that just don't meet the stricter rules of the main exchanges. You hear about the OTC bulletin board or pink sheets, that's this area.
Heard of pink sheets, yeah. It sounds a bit risky.
It definitely can be. A big thing here is transparency. These companies often don't provide as much detailed info as listed ones. So much higher risk. Lots of penny stocks trade here under $1. They can soar, but they can also easily become worthless. Honestly, for newcomers, probably best to steer clear initially.
Okay, good heads up. That makes the distinctions clearer. But it gets me thinking, why does a company land on the NYSE versus NASDAQ? Is it just their pick, or do the exchanges have different gates they have to pass through?
That's a great question, and it really gets into how a company goes public. It's actually a mix of both. It's about meeting the market's strict requirements and then making a strategic choice.
Like applying to college. You need the grades, but then you choose the school.
Exactly like that. Perfect analogy. First, you have to meet the admission standards. If you don't, you can't get in. The NYSE, as we said, has the toughest bar. They want consistent profits, big market value, lots of shareholders globally, really for the established blue-chip players. Nasdaq is also strict, but it has different tiers. Some are easier for newer, growing companies to meet. And crucially, Nasdaq lets companies list even without being profitable right away.
Ah, that's the key for the tech startups, right?
Precisely. If they meet other criteria, like having significant assets or a really high market cap or lots of shareholder equity, they can list. It opens the door for those innovative firms pouring everything into R&D. The OTC markets, they aren't official exchanges. They're more like dealer networks. The standards are minimal, just basic info filed with the SEC, the Securities and Exchange Commission. It's a place for startups, companies in trouble, or maybe foreign firms avoiding the higher costs of the big exchanges.
Okay, so if a company can qualify for both NYSE and NASDAQ, how do they choose?
That's the strategic part. It comes down to image, mostly.
Yeah.
What story do they want to tell? NYSE screams stability, history, trust. Good for financials, industrials, consumer goods, wanting that blue chip feel.
And Nasdaq.
Nasdaq signals innovation, growth, technology, the future. Natural fit for tech, biotech, internet companies focused on cutting-edge stuff. Other factors, too. How trades happen. NYSE uses designated market makers for stability. Nasdaq uses multiple competing market makers, often meaning lower costs, maybe more liquidity. Who are their peers? Do they want to be grouped with Coke and JP Morgan or Apple and Amazon?
Right, the neighborhood matters.
It does. And costs, services offered. NYSE might have higher fees, but maybe more media exposure. Nasdaq might be cheaper, offer different corporate services. So if they meet the standards for both, it's about identity. Stable traditional powerhouse on NYSE or innovative future leader on Nasdaq.
That makes a lot of sense. Okay, so the company's listed. Now, for someone like me or one of our listeners,
Huh.
how do we actually buy or sell these stocks? Sounds
Okay.
daunting, maybe.
You know, it really isn't these days. It's surprisingly streamlined, especially compared to how it used to be. Buying U.S. stocks, even from overseas, basically boils down to about 5 steps.
Okay, walk us through it.
First, open a brokerage account. Lots of firms let you do this completely online now, very easy. Second, you probably need to activate an overseas stock trading feature, usually just a click or two in the app.
Simple enough.
Third, deposit money into the account, whatever you plan to invest. Fourth, you'll need to exchange that into U.S. dollars. Again, most brokerage apps have a simple currency exchange tool built right in.
Got it.
And finally, step 5, you trade. You just search for the company, ticker symbol, say AAPL for Apple. Enter how many shares you want, the price you're willing to pay.
Yeah.
Place the order. Done. Selling is pretty much the same process in reverse.
Okay, that really does sound straightforward. So timing. The U.S. has all these time zones. When are the markets actually open? Is it a 2:47?
Good question, especially for international investors. No, it's not quite 2:47, though it feels like it sometimes. The main action happens during regular trading hours. That's 9:30 a.m. to 4:00 p.m. U.S. Eastern Time. Most trades happen then.
But there's more, right? I hear about trading before or after the market opens.
Yep, that's extended hours trading. You've got pre-market, which is usually about maybe an hour and a half before the 9:30 open, and after hours, which runs for about 2 hours after the 4 p.m. close.
Why would people trade then?
The big reason is news. Major company announcements, like earnings reports, often come out after the market closes or before it opens. Extended hours let investors react to that news immediately.
Ah, makes sense. Any catches?
Definitely. Big caveat for new investors. Trading volume, the amount of buying and selling, is much lower in extended hours.
Meaning
Meaning it could be harder to get your trade executed.
Yeah.
And harder to get the price you want. Because there's less activity, even small buy-or-sell orders can cause big price jumps or drops. Imagine dropping a pebble in a small pond versus the ocean bigger ripples in the pond.
Okay, so more volatility, potentially harder to trade. Good to know.
Exactly. So while it offers flexibility, approach extended hours with a bit more caution.
Right. Now, thinking bigger picture again, a listener mentioned derivatives markets like the Chicago Mercantile Exchange, and also we keep talking NYSE, Nasdaq, OTC. But are those the only exchanges? How many are there really?
Yeah, great points that often cause confusion. Let's tackle the Chicago Mercantile Exchange, CME, first. Super important. The CME is a derivatives exchange, not a stock exchange.
Okay, what's the difference?
A stock, like we've been saying, is ownership in a company, a piece of the pie. Derivatives are different. They're financial contracts where the value comes from something else, an underlying asset. That asset could be a stock, but it could also be oil, gold, currencies, interest rates.
So at the CME, you're not buying Apple stock itself.
Exactly. You might be trading an option, which is the right to buy or sell Apple stock at a set price later, or a futures contract on something like corn or oil. It's about contracts based on assets, not the assets themselves. Most U.S. derivatives trading happens in Chicago, like the CME Group, and also New York with IC Futures US.
Got it. Derivatives are separate. Now, the number of stock exchanges.
Right. It's way more than just NYSE and Nasdaq. As of 2024, believe it or not, there are 24 national securities exchanges registered with the SEC in the U.S.
24? Wow. Where are they?
Many are actually subsidiaries of the big groups, NYSE, Nasdaq, and another big one called SIBO. So, for instance, the Nasdaq group doesn't just run the main Nasdaq exchange. They operate several others, too, like Nasdaq UBX or Nasdaq PHLX.
Why so many?
It's about specialization and efficiency. Different exchanges might focus on trading specific things better, like certain types of stocks or options or ETFs, exchange-traded funds. It helps the whole system run smoothly. You hear about new ones popping up, like the planned Texas Stock Exchange, TXSE. It's a constantly evolving competitive landscape.
Okay, that's fascinating. But then, if there are 24 exchanges, why do we, and like all the financial news sites, only ever seem to talk about NYSE, Nasdaq, and maybe OTC? It feels like we're missing a huge part of the picture.
That is such a sharp observation, and it gets to a really crucial distinction that's mostly invisible to us as investors: the difference between a listing market and a trading venue.
Okay, explain that.
Think of it this way.
Yeah.
NYSE and Nasdaq are like the giant brand flagship stores, Apple stores, Nike towns. It's where companies choose to officially launch their shares, their big debut, their IPO.
Their main address.
Exactly. The other 20-plus exchanges. They're like the massive network of authorized retailers, Best Buy, Amazon, local shops, that actually handle the day-to-day buying and selling of those shares after they've been launched.
Ah, okay. So why the focus on the flagship stores?
It's all about the primacy of listing. When a company goes public, it picks one primary home, almost always NYSE or Nasdaq. That choice says a lot about the company's identity, remember, stability versus innovation.
Right, the branding.
Yeah. And all the major stock indices we follow, S&P 500, Dow Jones, Nasdaq 100, they're based on companies listed on NYSE or Nasdaq. So news coverage naturally focuses on the company and its chosen listing market, its symbolic home, not the specific, often invisible place where your individual trade happened to get executed.
So what are those other 20 exchanges actually doing then?
They're the invisible, vital infrastructure for efficient trading. The U.S. market operates under a system called the National Market System, or NMS. The core principle is simple but powerful. When you place an order to buy or sell stock, your broker must route it to get executed at the absolute best available price across all 24 exchanges at that exact millisecond.
Automatically.
Automatically. So you want to buy Apple, Nasdaq listed.
Oh.
If at that instant some other exchange, maybe one run by SIBO, is offering it for even a fraction of a cent cheaper than Nasdaq itself, your order zips over there and gets filled. You, the investor, never even see it happen.
Wow, so they're competing for my order behind the scenes.
Constantly. Competing on speed and price, they're the essential plumbing, the power grid of the stock market, ensuring everything runs efficiently and you get the best possible deal.
Yeah.
Vital, but invisible.
Okay, that makes sense. And then OTC is just different.
Totally different category. Remember, OTC isn't an official exchange. It operates outside that highly regulated NMS system. It's the alternative for companies that don't meet the high bar of NYSE Nasdaq, maybe they're too small, in financial trouble, or foreign firms wanting a lighter touch.
So seeing a stock is OTC is like a signal.
It's definitely a signal. It suggests potentially less information available, maybe lower financial stability. That's why it's treated separately, often with warnings about higher risk. So, yeah, to sum it up, NYSE and Nasdaq are the main stages, the protagonists. OTC is a different league altogether. And those other 20-plus exchanges are the incredibly important but largely invisible technical crew, making the whole show run smoothly for everyone.
That's a fantastic way to put it, the invisible technical crew. Okay, but this brings up that other point you mentioned, the strictness. If the standards, especially on NYSE and Nasdaq, are so high, why do we see so many companies listed, particularly on Nasdaq, that aren't actually profitable? It still feels like a bit of a contradiction.
Yeah, you've really hit on probably one of the most important and maybe misunderstood aspects of the U.S. market, especially Nasdaq. It seems like a contradiction, but it reveals the core philosophy. The standards are strict, but strictness isn't defined solely by current profit.
Okay. How else is it defined then?
It's more like there are multiple paths to proving you're a good company worthy of listing. Think of it as an or condition, not an and condition. A company only needs to satisfy one of several demanding financial criteria. Let's use Nasdaq again as an example. They basically have four main ways a company can qualify financially. There's the traditional earnings test, show consistent profits over the last few years. Classic model.
Right, the expected way.
But then path two, the capitalization with cash flow test. Here, a company might not be profitable on paper, but if it has strong operating cash flow and a really high market capitalization, meaning investors value the company very highly, it can list.
So the market believes in its future value, even without profits now.
Exactly. Path three is similar. The capitalization with revenue test. This is for companies with maybe explosive revenue growth, really scaling up fast, and a high market cap. Again, the market sees huge potential.
Think early Amazon. Losing money, but growing like crazy.
Perfect example. And path four, the assets with equity test. This looks at the company's balance sheet. If it has substantial total assets and significant shareholders' equity, that demonstrates underlying financial soundness. even if it's not currently generating profits.
Okay, so multiple ways to prove you're solid, but why allow unprofitable ones at all?
It boils down to this core philosophy.
Hmm.
The U.S. capital market, particularly Nasdaq, deeply values future growth potential, arguably even more than current profitability. It's about funding innovation.
Funding the next big thing.
Precisely. Think about Tesla in its early years, or many biotech firms. They often run intentional strategic deficits. They pour every penny and more into R&D, building factories, capturing market share, knowing profits will come later if they succeed. That deficit isn't seen as failure. It's aggressive investment.
So the market is basically getting on their future.
Exactly. The exchanges verify a baseline of financial soundness through one of those pans we mentioned. But the ultimate judgment on future value, that's left to investors. If you buy stock in an unprofitable Nasdaq company, you're making a calculated bet on its future success. So strictness here isn't just a simple profit check. It's a multifaceted strictness demanding proof through market cap, revenue, assets, cash flow, or earnings that the company has significant substance and potential. This dual path, welcoming both profitable blue chips and innovative high-growth firms, is really what makes the U.S. market such a magnet for global companies.
That really connects the dots. So that structure, that philosophy, that's fundamentally why so many innovative companies seem to be born or grow big in the U.S. It's the system that fuels the innovation engine, despite any other issues the country might face.
You've nailed it. That's exactly right. Despite all the complexities, the fundamental engine driving U.S. leadership and innovation is this dynamic system designed to connect ideas with risk-taking capital. And the stock market, as we've seen, plays a huge role, especially in that later stage growth funding. You can almost visualize it as like four big gears working together in America's innovation engine.
Okay, what are the gears?
Gear one, the source of ideas. You got world-class universities and research institutions, Stanford, MIT, countless others, often heavily funded. They churn out foundational technologies and brilliant minds. Google's algorithm, right? Started as a Stanford project.
Right, the seed corn.
Exactly. Gear two, the early stage venture capital VC ecosystem.
Yeah.
Those ideas don't just magically appear on Nasdaq. You have this incredibly deep pool of VCs who find promising early stage companies, give them intense funding, seed rounds, series A, B, C, and often get deeply involved in management. It's high risk, high return. Many fail, but one huge hit pays for everything.
And then they reinvest the profits.
That's the crucial part. The returns from successes get plowed back into new startups. It's a virtuous cycle. Gear three, the stage for massive growth and exit the stock market, NYSE and Nasdaq. This is where companies go public via IPO. They raise billions for global expansion, more R&D, and, crucially, it's the exit for those early VCs and founders. They cash in, realize huge returns.
And reinvest again.
Exactly. Keeps the whole engine turning. And finally, gear four, maybe the most subtle but vital, a culture that tolerates failure.
How so?
In the U.S. entrepreneurial world, failure isn't always the end. Sometimes it's seen as valuable experience. An entrepreneur who tried and failed might even be seen as more knowledgeable. This cultural safety net encourages people to take bigger risks and to try more audacious things. So yeah, it's this whole ecosystem ideas, early funding, massive growth capital via the stock market, and a culture that accepts risk and failure, all interconnected. That's the powerhouse.
That makes so much sense. It reminds me, Warren Buffett famously said something like his success was basically down to being born in America and investing in American companies.
He absolutely did.
And Peter Lynch, I remember reading he was almost disappointed that we don't treat entrepreneurs like heroes, that he thought they were the real heroes creating value.
You're spot on. Both Buffett and Peter Lynch, and their contemporary Charlie Munger too, deeply understood that the American economic and capital market system itself was foundational to their success. It wasn't just about stock-picking skill. It was about the playing field. Buffett often talked about winning the ovarian lottery, just immense luck being born in 20th century America. He said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest."
Lucky genes and compound interest. I like that.
Right. And he constantly talks about the American tailwind.
Yeah.
He wrote in a shareholder letter something like, "For 232 years, it has been a terrible mistake to bet against America. The American tailwind will continue. All we have to do is raise our sails to that tailwind." He saw America as this incredible incubator due to its dynamism, rule of law, property rights, and this capital market system fostering innovation. He invested with profound faith in the system's long-term power.
Wow. And Peter Lynch.
Peter Lynch, yeah, he championed the entrepreneur. He said things like, "In this country, America, thousands of new companies are created every year, and one of them becomes the next Xerox or Walmart." Capitalism is a much more exciting field than sports or politics. He felt the real heroes weren't athletes or politicians, but the people building businesses, creating jobs, making products. Investing, for him, was participating in that adventure, backing their vision. America, he felt, was the ultimate stage for these heroes.
That's a great perspective.
And Charlie Munger, Buffett's partner, called the mix of free markets and democracy almost a miracle of human invention. He believed the system's toughness. The fact that failure is possible is what keeps it healthy. Capitalism without failure is like religion without hell, was one of his lines. So, yeah, these masters saw the big picture. The system itself was the magic.
I find it a pity that people think of the stock market as a casino. I believe its core actually lies on the IB side, injecting capital to create new history. When trading is emphasized, it looks like a casino. You've really helped clarify that there are these two sides.
That's a really insightful way to frame it, and you're absolutely right. The stock market really does have these two crucial coexisting phases: the engine of capital raising and the plaza of price competition.
The engine and the plaza, I like that.
The first phase, the engine of capital raising, is the fundamental purpose. This is the primary market where investment banking, IO, plays the lead role. Think about the IPO, the initial public offering. IB helps value a company, convinces investors of its vision, and secures that vital first injection of large-scale capital. The ammunition for R&D, building factories, hiring people. Almost every major innovative company grew this way.
That's the history-making part you mentioned.
Exactly. IB also helps already listed companies raise more money later through seasoned equity offerings for new projects, and they facilitate mergers and acquisitions, M&A, reshaping industries. This primary market function is where the stock market pumps lifeblood into future-creating companies. It's about vision and growth, not really speculation.
Okay, so that's the engine. What about the plaza? The part that looks like a casino.
Right, that's the second phase. The Plaza of Price Competition, or the secondary market.
Mm-hmm.
This is where stocks, once issued in the primary market, are traded back and forth between investors like you and me. This is the visible, daily activity, and yeah, this is where the casino perception comes from.
Because people are betting on price movements.
Sure, speculation, short-term trading, emotional buying and selling, that definitely happens here. Derivatives trading adds another layer. But even this plaza serves incredibly important functions that actually support the engine. Most importantly, it provides liquidity. The fact that you can easily sell your shares whenever you want gives investors the confidence to buy shares in the first place, especially during an IPO. Without a liquid secondary market, the primary market wouldn't work.
Ah, so the casino enables the engine.
In a way, yes. It also performs price discovery. All that buying and selling constantly determines a company's perceived fair value and reflects the market's collective judgment about its prospects. And finally, it acts as a monitor of management. If a company's stock price tanks, it's a huge red flag for the CEO and the board. It keeps them somewhat accountable to shareholders. So that analogy that you liked earlier, the primary market, IB, is the car factory designing and building new cars. The secondary market trading is the giant dealership complex where those cars are bought and sold daily. Mistaking the whole stock market for a casino is like looking only at the noisy, bustling dealership floor and completely ignoring the massive, innovative factory behind it that's actually producing the cars. The factory needs the dealership to sell its cars, and the dealership needs the factory for new inventory. They're symbiotic. So, yeah, your initial point was spot on. The deep core value lies in that primary market function funding innovation and growth. The secondary trading market, while sometimes looking chaotic, is the essential mechanism that makes the whole system possible.
That provides such a clear and, frankly, more inspiring picture of what the stock market is really about. It connects the dots from a simple trade all the way back to innovation and the vision of entrepreneurs Peter Lynch admired so much. This is a word from Peter Lynch today, and this principle is connected not only to investment decisions, but also to life wisdom. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.